Welcome to Chart This with Dave Keller. It's Thursday, January 16th. I appreciate you so much joining me here. Apologies for the late kickoff. I actually was out for grabbing lunch, and boy, did not time my return particularly well. Apologies for that. Interesting day today, and as we get through some of the charts here, we'll talk about sort of the incredible strength we saw on Wednesday. I guess counterpoint to that strength, and where all the bulls come right back out. I feel like today, you're back to Apple kind of in a primary downtrend all of a sudden, and you're back to, sort of the NASDAQ leading the way lower. And yesterday's action feels almost like short covering, kind of like a quick counter trend rally before the downtrend resumes. Now, having said that, right, I mean, I think at the end of the day, price is what's most important. That is absolutely true at any point, but particularly now when we're thinking about the charts and how they're playing out. So, we can talk about what the market could do. At the end of the day, it's what the charts are telling us based on how the price action represents that that play between fear and greed, between bullishness and bearishness, between supply and demand, however you want to describe it. With that in mind, a couple other quick comments. Actually, as I bring up my charts, a shout out to my friends at the CMT Midwinter Retreat down in Tampa. I'm so sorry I couldn't make it with you. Had some complications with this cold that I'm getting over, and couldn't make the trip. I'm so sorry, but I wish you guys a great conference, and I'm wishful that I was there with you, enjoying a little warmer weather and warm company with some great friends around the financial industry. So please enjoy, guys. Also, what else did I want to tell you? I'll be doing a webinar with Fidelity coming up next week. I'll be doing a great interview with one of the CMTs on staff at Fidelity, working with the Active Trader Pro community, and certainly happy to have you join me there. Should be a link in the description for you to sign up for that free webcast offered by Fidelity, and I'll look forward to having a good conversation there. Talking about the markets here, let's look at the market recap and see how things actually played out. We can see that the S&P 500, the Dow, the NASDAQ, all in the red today, but by varying degrees of red, right? If there were shading here on the stock charts front page, we might see some differentiation, but generally we're seeing everything slightly down today, at least the major large cap indexes. The NASDAQ leading the way lower, down about 0.9%. The S&P 500 down about just under 1/4%, and that finishes us around 59.37, just slightly above that point. The Dow, the top performer of these three, just down just below 0.2%. Worth noting, mid caps and small caps going up today. The mid cap S&P 400 index is the top performer, up about 0.8%. Looking at the bottom here, the VIX popping higher, about 0.5 point for the VIX, still in that low volatility range below 20. So anything below 20, I mean, generally speaking, I just kind of think of as noise. Anything above 20 is when you need to start to pay attention to it. That's why I kind of have a perpetual price alert on the VIX going above 20. And anytime it happens, my phone lights up. I see it on the top of stock charts. I get an email, and I'm a big fan of alerts like that. Once you come up with sort of a major thing that you need to see, like the S&P breaking below 58.50, which was our line in the sand, the VIX pushing above 20, any of those kind of things, set an alert and then stop worrying about it. Just move on and consider anything outside of that break to just be noise, right? Not a lot of signal. I think a lot of what we think of in the technical analysis community, at least I think the best thinking is separating the signal from the noise. That's what a lot of quantitative methods are focused on as well. We way too often get caught up in the noise. Let's focus on the signal. So pick up on those key levels, those key triggers that will tell you something's new and different. Looking at the interest rate environment, the bond market, bond prices moving slightly higher. You see the TLT was up about 1/3%, just above $87 for the TLT. That's basically a treasury bond ETF, long end of the curve. Interest rates generally moving lower. The 10-year yield is just about 4.6%. The long bond yield around 4.85, and the 5-year point around 4.4%. So we're seeing stronger bond prices and some weaker interest rates. Of course, the general trend for quite some time has been higher rates, right, and weaker bond prices. As I believe we shared on yesterday's show, we have the TLT kind of bouncing off of a fairly low level. The daily PPO, which is an indicator very similar to MACD, which is a trend following technique, looking at the crossover of those two moving average based lines, giving a buy signal this week for bond prices, essentially a sell signal for yields, or suggesting that interest rates are are heading lower, and that's certainly what we're seeing through the course of this week. Dollar index, no change in the UUP. Literally finished today right around where we started, or where we closed yesterday's trading. It did open much higher, and I wrote an article for stockcharts.com, which just went out earlier today, digging into some of the key factors that could affect small cap stocks. And I think a strong dollar is a big part of that. Some of my recent conversations on the Market Misbehavior podcast, people like Adam Turnquist, great conversation yesterday. He's with LPL Financial, talked about dollar strength. I interviewed Sam Stovall earlier today, who's the chief strategist at CFRA Research, long time at S&P Global. And I'll hopefully get that episode out for you later today, most likely tomorrow morning, but a really good conversation about a lot of macro themes. I think a lot of things that don't feel like they make sense at the moment may make sense after you listen to Sam, who does a great job of sort of helping put things into proper context. So look for that episode very, very quickly. For today, no real upside follow through in the dollar, although I think stronger dollar is a key theme to be watching in early 2025. Precious metals continuing to recover, continuing to push higher. The chart of the GLD has been breaking out here just above 250 today. That's up about 0.7% from yesterday. Silver prices up about 1/3% from Wednesday's close. Copper prices as well. Crude oil went down today, and energy was sort of middle of the pack again. But again, the general trend in crude oil prices have been higher. Crude oil, in terms of the crude oil future, kind of getting to that $80 a barrel level, which is one of those levels we've been talking about for quite some time as a potential signal that we're breaking to new swing highs. That's not the USO that I'm talking about. That's the crude oil future, the front contract that we're talking about there with $80 a barrel. So keep an eye on that. Strength in energy stocks comes from strength in crude oil prices, most likely. Looking at the cryptocurrency space, we can see in the little preview chart here, Bitcoin has been toying over and over with that 100K level. That's the level, right? That I think is the resistance for now. Although we have traded slightly above it to 8% above it when we got up to 108 a little while ago. Just not following through above 100,000 just yet. Here, just in the last 6 to 12 hours, we've seen a nice bounce back above 100,000, but currently trading just below that, around 99,850. Again, the long-term structure of Bitcoin is still fairly strong, as long as and assuming we can push above 100,000 and stay there. We have a chart in a moment, because the Bitcoin ETFs were approved and finally released into the investing community just about a year ago from this week. So we have a chart just celebrating, I guess, the first 12 months of returns on those spot Bitcoin ETFs, up about 100% from their initial starting point. So not a bad start to those ETFs for sure. Bitcoin and Ethereum both slightly lower. The rest of the top 10 coins mostly in the green. And in terms of disclosures, out of everything that I showed, I own plenty of S&P index funds, but not the SPY. But we'll just assume that that's close enough. GLD, Bitcoin, Ethereum, all things that I own. I don't believe anything else at the moment out of that list. All right, looking at the 11 S&P sectors. Hey, one of the things we've been talking about, right, for quite some time is the dangerous signal that would be represented by defensive sectors breaking out. And don't look now, today, the top two sectors were utilities, up 2.5%, real estate, up 2.25%, then a big gap down to industrials, up 1.2%. Now, this is just one day's trading, to be clear, and one day does not make a trend. However, this is one of those things you look for when you think about what a bearish scenario could look like from here, right? We had that initial move down from mid-December to early January. We've now had a nice counter trend move higher this week with inflation data, with earnings coming out, and with banks killing it on basically day one of earnings season. But now the question is, what's next? And you have FANG sectors in the red, which I'll mention in a minute, and defensive sectors like UTS and real estate at the top of the leaderboard. This is very much, I think, a theme to be looking for. I think there's a very real possibility that we see a much more defensive move before this sort of January, February kind of period is over. But defensive sectors rallying to the degree that they are would suggest to me that that's a much more likely outcome. On the downside, the three sectors in the red, the only three are the Magnificent Seven sectors. Technology down 0.8%, communication services down 0.6%, consumer discretionary down 0.5%. So again, not horrible days for those sectors, but worth noting after yesterday's incredible rally led by mega cap growth. Today, it's defense working and offensive growth not working, which is, again, I think, a great pattern if you're bearish, because it certainly looks like there's downside follow through to be had. Interestingly enough, though, if you look at equal weighted measures of performance today, and that's what advanced decline data or any sort of breadth data for the most part is based on equal weighted measurements, right? Indexes like the S&P 500, like the NASDAQ 100 are cap weighted, which means the biggest names have an outsized impact, right? So like the top 10 stocks in the S&P are worth about as much to the value of the index as the bottom 430, 440 kind of names. And that's how outsized, that's how different it is between the mega cap, Meta, and Apple kind of names versus the smaller names in the S&P. It's like a totally different impact. That's why breadth data, I think, is so valuable, because it's equal weighted. It's just counting the number of stocks, regardless of their size, regardless of their market cap, just counting stocks that have particular characteristics. So today, 3 for 1, right? 3 out of every 4 S&P names were actually up today. So even though the major indexes, some of the bigger weights like consumer discretionary and technology, which is about a third of the S&P 500's value by market cap, were in the red, most stocks were actually in the green today. We'll see that on the heat map here in a moment, but I wanted to point that out there as well in terms of breadth conditions. Looking at the Magnificent Seven and Friends, you can see all of these leading growth names were in the red today. Microsoft down the least, down 0.4%, followed by Netflix down about 0.7%. Biggest losers today, Apple and Tesla by far. Apple down over 4%, Tesla down over 3%. NVIDIA not far behind, down about 2%. So some of these key names struggling, right? I think that is the bear case from here. And you see what happens when these names are down, but 3 out of every S&P stocks are up. The indexes are down, right? And that's how big of a weight these have. So if you're bullish on the S&P, you're bullish on the Magnificent Seven stocks, really. I mean, based on the calculation of the index, you're basically saying these things are going to lead. I don't know if I'm comfortable making that assessment at this particular moment, because there are charts that look a lot better than Apple right now. And I think that is that's the reality facing investors here in January of 2025. All right, let's go to a heat map style visualization called the market carpet on stock charts. Big fan of this sort of visualization, because it helps us sort of put things into proper context. So step one, what's your overall impressions here? I mean, obviously the average stock was up today, and you can see that by a lot of green across all 11 of the S&P sectors. Now, having said that, I would also observe that the biggest names, which of course are the growthy names like Apple, Alphabet, Meta, Amazon, Tesla, NVIDIA, and Microsoft, were all in the red today to varying degrees, right? And I think that tells you the story today. It was mega cap growth struggling, kind of everything else doing pretty well. After a really strong start to earnings season, a little less optimistic day today, although the financial sector overall was positive. We didn't have that big surge higher that we saw on Wednesday's session with some of those leading names like a Bank of America, Citigroup, Goldman, JP Morgan having really good quarters and bouncing higher to a good degree. Still kind of generally fine, but not as much of an upside follow through today. Today's sort of a wait and see day. We'll see what happens through tomorrow. We've got some earnings today and tomorrow from more regional banks, some of the smaller players within the index and the financial sector. We'll see how the week overall plays out. Other things that I would observe, I mean, communication services is probably one of the least impressive sectors, and it's not just the Alphabet and Meta effect, both of which were in the red, but on average, very few of these names were actually in the green. Here's Match, which was one of the few that actually had a decent update. Take-Two wasn't too bad, and it's one of those names not too far off of previous highs around 190. But generally, this is not a great day for communication services. It was a fantastic day for REITs and utilities. Also, some of the value sectors like industrials, like healthcare. These are sectors that had actually pretty decent up days. And again, I'm concerned every day when I bring up the market carpet. I kind of what I'm figuring is I'm doing 3 things. Number one, kind of take a step back. What's the overall view? Number two, look at the biggest names because those are what are moving the index. And then I find I'm looking down to the defensive sectors of REITs and utilities and staples and seeing if there's enough green there to suggest that investors are rotating to more defense. Sort of what we see today. Not as much of a trend just yet, for sure. All right. Thanks, of course, all of you for tuning in. Those of you that are doing it live, I appreciate it very much. I can see questions that are coming in on any of the platforms on which we are currently streaming on Facebook, on LinkedIn, on YouTube. The X feed did not go out today, and I'm not entirely certain why that happened. So apologies for that if you normally watch it on the Twitter or on X. But elsewhere, it looks like we're getting the message out just fine. If you're watching the replay on our YouTube channel, for sure, I appreciate you as well. Drop a comment if you're watching it live, and or a question if you could, and I'll try to answer your question before the end of the live stream. If we don't get to it, we'll put it in the mailbag. We are planning an all mailbag episode tomorrow on Friday the 17th. We'd love to answer one of your questions live on the air. All right, getting to the charts here. What did today do? Well, today was sort of a day, sort of a not much of a change day. Yesterday was the big gap higher. Yesterday was where it felt like all the bulls were coming out screaming, super excited, and you may well be proven absolutely right. I don't want to suggest that, I'm right and you're wrong by any means. One thing I've learned about investing is you got to be humble and be prepared to be wrong a lot more than you want to be. However, I'm still seeing a lot of reasons to not be particularly constructive, particularly given the weakness in some of the Magnificent Seven stocks today, as we'll see. But from a purely technical perspective on the S&P 500, once we break below 5850, I think you have to approach a chart like this. You may have a neutral option, right? You may just be wait. And if that's an option you have, I think that's where we're at today, because we're between the 50 and 200-day moving average. We've made a pattern of lower highs off of the December peak, but we're not really breaking down anymore. We just gapped higher. We haven't made it to the 200-day. So things are not horrible, but things are not great. So it really is neutral. However, I tend to think things more binary, right? It's either bullish or it's bearish, because I either have to own the S&P or not, right? I have to have exposure or not. So I just want to think of what the primary signal is. Now, I have my market trend model, which is an automated sort of systematic way of measuring those trends, which I look at every day. But I would also say, from this chart, the break below 5850 for me represented a change of character. That represented that the primary trend is now down, because we're making lower highs and lower lows on the most important time frame, in my opinion. Which means even if we bounce this week, which we have, I still see this as a primary downtrend until we clear the 50-day moving average, which we traded up to yesterday and opened at today, but did not close above. And then also, I would say following above trendline resistance, which is the pink line that you see on the chart of the S&P 500. Those two things happen. I won't tell you that the market is or that the trend is bearish anymore. I would say that's no longer a valid head and shoulders pattern. That was a failed breakdown. We're probably going back to retest 6,100, at which point I'd reassess, but I probably assume that the primary trend is back positive. But we're not seeing that yet. And until we see that, I still see this as a pattern of lower highs and lower lows. And if you want to call this like a bear flag pattern, it's not a perfect one, but I get the argument. We break above the pink trend line, and that would complete that bull flag pattern and suggest much further upside. The QQQ has a much more, I would say, clearly defined bull flag pattern. Again, we haven't broken above that upper line just yet, but that's what you would look for, I think, to exit sort of this bearish framework that I think has been very clearly represented by the data. All right. Going rapid fire through some other charts here, because I have a number of things here. The AAII survey, we didn't do a show on Friday, or I would have mentioned, and I just neglected to do it on Thursday of last week. But I wanted to point out the fact that the AAII survey has tilted to, one of the most bearish readings that we've seen, certainly in over a year. You have to go back to October of last year to find when this weekly survey of individual investors has been so bearish. As of last Thursday, which is when the data is this is as of today. Today, when it's reported, we're down to 25% bulls. Last week, which is when I meant to bring this up, it was up around 32% or so. Now, this is well below almost 50% where we were in mid-November, end of November. So we've come down pretty consistently almost every week. But this last week was one of the biggest changes where we saw a lot of bulls kind of throw in the towel. The bearish reading has increased down to around 41% bears. So that spread of around 15% of bears minus bulls is one of the lowest readings. That's the series at the bottom, just simply looking at bulls minus bears to get sort of a net difference between the two. We can see that for pretty much the entirety of 2024, except for a couple days, couple weeks, we had bulls outweighing bears almost the entirety of the year. All of a sudden this week, we get a negative move. After last week, slightly negative. This week, again, the most bearish reading we've seen since Halloween of 2023. Now, worth noting, that was during this pullback phase, and pretty much right when we had been pounding out a low is when the bearishness got much further below that. But I think the challenge here is protracted declines will often see that initial gap, but then you get way more bearish readings when things really start to sell off. So we're getting that sort of taking the foot off the accelerator signal, but not the stopping on the brake, throwing in the towel and selling everything. We're not getting that from this chart, but certainly getting very similar readings to previous pullbacks, and especially from previous bear market phases toward the beginning, when you see that initial lack of optimism suggesting that this bullish phase potentially may be over here. Now, some of the breadth indicators in the short term have turned back positive. I mentioned today, 3 out of every 4 S&P stocks were higher. The McClellan oscillator, and this is as of yesterday's close on Wednesday, it's not updated for today just yet, but I would assume based on what I saw that this line probably goes a little bit further to the upside as of today's closing data. But it's worth noting that the McClellan oscillator did break above zero yesterday. That's one of those short-term measures of breadth that, generally speaking, that line being above zero just tells you that the breadth overall is okay, that the advanced decline data is constructive and suggests that overall we're in a position where we could advance further. We've been negative pretty much since early December through most of the month so far until this week. So something to monitor for sure to see if you get a resurgence in the McClellan oscillator. I would put this with other things like the chicken money flow and other signs that there's maybe more optimism than the chart of the S&P and the NASDAQ might imply. Now, one area of the market where you're very much not getting a risk-off feel would be in the high-yield bond market. Here's the high-yield option-adjusted spread. So this is basically credit spreads using junk bonds. So how much are bond investors looking or pricing in elevated risks right now? Now, the spreads actually were widening out from early November down to late December toward the end of last year. And this is plotted upside down, just so we're clear. These numbers going up means spreads are widening, which means bond investors are getting a little nervous. Spreads have come back in and actually tightened up a bit in the last couple of weeks, and getting back toward the low levels that we experienced in November of last year. So that, combined with the VIX remaining below 20, tells me for 2 potential big warning signs. We did start to see an increase in volatility and a widening of spreads, but now we've actually started to lighten up a little bit as the month of January has begun. Something to watch for sure as a potential warning sign if you see those things spike higher. Bitcoin ETFs, it's been a year since those were finally approved. It's been a year since tickers like BITB, HODL, ARKB, FBTC, and all those new tickers that represent spot bond Bitcoin ETFs have been released. Now, GBTC is the main ticker that we're starting with. That actually was around in a trust structure for many, many years. Of course, it became an ETF when these other ETFs were approved, and that structure was approved by the SEC. From that starting point, beginning of January of 2024, I just wanted to point out that the average ETF in this group is up about 100 to 108%, call it 104%. And most of these are kind of in that cluster of returns. The GBTC has actually been the top performer, and it's actually outperformed the rest of these by a pretty decent clip. GBTC is up 120% compared to the others, up an average around 104, 105%. So what's the difference in these ETFs? Again, they're all very similar in that they're trying to give you exposure to Bitcoin. They're all obviously up quite a bit because the price of Bitcoin has been up over the last year. So I think they got their job done that way. But there's obviously a bit of a tracking error in terms of how well they're tracking those movements in Bitcoin. Differences that can be, certainly impact this. Fees and expenses that are wrapped into the returns can be a part of it. All of these are fairly low fee ETFs. I don't think that's a huge driver. The second thing could just be the natural premium and discount that these things have traded at. GBTC famously traded at a huge premium to Bitcoin prices during the previous sort of big bullish phase in Bitcoin, when GBTC was one of the only ways you could play Bitcoin without actually opening up a digital wallet or starting opening a Coinbase account or something. GBTC was kind of the way. It wasn't an ETF, but it was kind of like one. But there was a huge premium. So it would trade well above the net asset value of the cryptocurrencies it was holding to have that exposure. And I would argue that's probably a part of this. Also worth noting, there are some subtle differences in terms of the construction, how they're actually gaining the exposure, how they're modeling the price of Bitcoin. So worth noting that over time, the performance spreads can be quite wide. And from GBTC and down to ARK-B, which is the ARK Fund's Bitcoin fund, about a 20% gap over the last 12 months after initiation. So great, celebration, I guess, of the resilience of these ETFs. And we'll see what happens next. I do own GBTC as I'm looking at that chart. All right. Looking at the utilities sector, top performing sector today, the XLU was up 2.5%, and impressive move. And I think the gap higher that we saw yesterday today actually followed through. A lot of things like growth stocks actually gapped higher and traded off today. You see utilities and real estate actually moving higher. What's interesting today is we have now regained the 50-day moving average, the RSI pushing just slightly above 60. And those are things that are sort of in that recovery chart kind of a formula in my head. When you have something that's had a big pullback, I always think, can we regain the 50-day on stronger momentum? And if so, maybe that means we're going to resume higher. But I would say if you're looking at utilities, the real message should be in the relative strength, which is at the bottom here. From mid-December to now mid-January, you're seeing an improvement in the relative performance of utilities and REITs. And I think that is one of the most important lines to follow to gauge the rotation of different investors. Now, here's the relative performance of three defensive sectors over the last 2 years. We can see utilities starting to turn higher. Consumer staples really consistently underperforming. No change there. REITs potentially starting to bottom out, but really not outperforming in any meaningful way. Utilities clearly the best of the three. But look at the value-oriented sectors. Here's industrials, financials, materials, and energy. All four of those having a really strong January on a relative basis. Look how all these relative lines have really started to hook higher. So, arguably what's happening here in January is a leadership rotation. And I'm curious what will sort of emerge in a new position of strength as we get through January, which means a new president with new policy changes and potentially significant changes to policy within the next week as we get to the inauguration early next week. Inflation data sort of giving people a sense of what the Fed may do. The first Fed meeting at the end of January, all of those things sort of bring into question what's going to emerge in a position of strength. For now, certainly seems like value sectors are starting to do that. Boy, the chart of Apple is not good. It really isn't. I mean, it's not horrible, right? I mean, there are worse charts I can find for you. And I have a couple handpicked later in the show that I'll share with you that I think tell the story pretty well. But for now, Apple's not a great chart. And I would say, if you think about what's happened this week, we broke the 50-day moving average. We rallied up to the 50-day from below. And today, kind of following through to the downside. So my concern is this a preview of what's going to happen elsewhere with the mega cap growth space? Sort of these counter trend rallies become sold. And all of a sudden, there's nowhere for the market to go but down. And again, if the Apples of the world are down and a bunch of smaller restaurants are up, right? The S&P and the NASDAQ are still going to be down quite a bit because that's the market, right? It's these larger names that have the huge weight. So Apple, down 4% hurts. Apple failing to hold its 50-day and then failing to regain it this week doesn't feel good either. The momentum getting pretty weak, breaking below 40 where it's been for the last week doesn't make me feel good as well. So key name, key growth stock, key weight in the benchmarks and certainly in the XLK in a position of weakness. Semiconductors, not a bad chart, but not a good chart, right? I mean, when I think about a chart like this, if I have the ability to vote buy, sell, hold, or bullish, bearish, neutral, this is the definition of a neutral, I would say, in that we are clearly range bound, right? You have a wider range from around 280 on the SMH from June and July down to around 200, which was the intraday low in early August, subsequent low around 215. From there, we've settled into a much narrower range. we've got around 260 on the upper end. We've got about 235 on the lower end. We have retested each of those levels multiple times over the last 3 months, really starting in October. Now the moving averages are flat. And in my opinion, with the RSI fluctuating between 40 and 60, this is the definition of a sideways trend. I think this chart becomes very constructive over 260. I think it becomes very negative below 235. And between now and that moment, I'm happy just waiting. Remember, Jesse Livermore's famous quote, there's time to go long, time to go short, and time to go fishing. This is one of those time to go fishing kind of charts. You wait to see which way we break. That's a trick. I remember hearing John Bollinger years ago in one of my first presentations I heard. I remember hearing John Bollinger talk, and he talked about a narrowing in volatility before a big move. And when you see the volatility come in, and he was, of course, demonstrating that with Bollinger Bands kind of coming in, that represents that the volatility is declining. And before you have a big move, you often have sort of the calm before the storm, that lower volatility range before the big break. And in some ways, these are the easiest charts because you just wait to see which way we break. So personally, I would be setting 2 alerts, one for a push above 260, one for a break below 235. Which way breaks first? There's your answer, I would argue, in terms of the primary direction of momentum from that point on. Bungie, and I'm actually not sure how to pronounce this company, and I meant to look it up, and I'll do it another time. BG is the ticker. I actually don't remember which way we pronounce this because it was such a funny ticker. We would always jokingly pronounce it all sorts of goofy ways. Now I've forgotten the actual pronunciation. I'll try to find a video of the CEO talking because they usually get the name of their company right. So we'll see. But looking at the chart of BG, and this is one that I was actually asked about maybe on yesterday's show or on the YouTube comments on one of our shows this week. You know, staples companies, food products companies, we highlighted a different one earlier this week. I mean, these are charts in primary downtrends. And the question was, you know, is this enough of a move to get excited or get it interested? And the answer is absolutely not. And I'll tell you why. When a stock is making a pattern of lower highs and lower lows, when the RSI is consistently below 60 and mostly below 50, when the relative strength is kind of going down fairly steadily, when the moving averages are sloping downwards and the price is below both of those, when all those things happen, there's not much I would get excited about. And while some have made a career out of buying very beaten down, undervalued stocks and betting on a reversal, that is not the way that I've learned to invest, at least in terms of my primary approach to investing. It's more waiting patiently for signs of accumulation. And that initial bounce higher, unfortunately, is now just making the latest lower high in this downtrend. So with staples charts like this, I'm happy waiting until we get a higher low. That first higher low is where I start to look and go, maybe this is the beginning of something else. And that's where we look at other indicators to determine, all right, are there enough signs of accumulation? What about the volume, right? The shaken money flow or accumulation distribution, some other techniques that could help us maybe appreciate that someone's taking a shot at these stocks. But those charts are still pretty bad, in my opinion. That's a technical phrase. All right, WBD in the communication services sector. You know, again, this was kind of a really incredible breakout from the low in August to a swing high in mid-December, just above 1250. From there, we've gone all the way below 10%. It's about a 26, 27% decline off of that intraday high in mid-December. That's a big drop. And this week, getting back below the 50-day moving average. And so I would say the fact that we then made a lower high at that point, I have to be skeptical of the move higher. So with this sort of rally, I mean, it's very easy to get drawn in. I don't blame you if you did. And I certainly would see this particular moment with a gap above resistance as a sign of incredible strength. When you have a stock that starts to go vertical, I think you have 2 ways of approaching this. Number one, start to lighten up on the position, because if you have a larger bet on something like this and it goes vertical, the bet you're making becomes bigger and bigger because it's naturally going to become a bigger and bigger percentage of your portfolio. So maybe you trim that back so you're not making an oversized bet as it continues to gain in value in a rapid fire period of time. The other option is just go full trend following and use things like the chandelier exit system to limit your losses on the downside. Use percent drops to make sure that you lock in gains once we make new highs. Some of those techniques would probably help you avoid at least part of this drop. And yeah, I saw someone just put a comment in, sell half. That's the other thing I would say. Remember, it's not an all in or all out decision. I find a lot of individual investors think way too binary with positioning. It's like, do I own it or not? And in my work with institutional investors, if they see something that's a really interesting idea, but super volatile and uncertain, they take a little speculative position. And if it works, they're thrilled. And if it doesn't work, they don't lose the farm based on this one stock. If it continues to demonstrate strength, maybe you add to the position. If it starts to not work, you lighten up a little bit. If you're not sure whether you should still hold it or not, take some off the table. And then at least you have a little less capital at risk and a little more, at least preservation, just in case we see further downside on a name like that. A couple other individual charts. I'll take a question or two. Boy, we're going long today. Sorry, I'm just all off my timing. I'll get better, I promise. TDG, the industrial sector, one of the better performers here. We saw the relative strength starting to improve. Names like this are coming up on some of my scans of stocks making new swing highs. Over the last week now, we've seen TDG, after bouncing off of the 200-day a number of times from mid-November to now early January, now following through to the upside, breaking above 1,300, which takes us above those previous swing highs. Also, the 50-day moving average, and I think that could be setting up really nicely for a retest of those previous highs, which is another 100-point above current levels. Finally, DXCM, I would say the healthcare sector as a whole is still a tough one on a relative basis. It's actually a pretty diverse sector in terms of the types of stocks that are represented there, from biotech to life sciences to supplies to equipment to pharma. However, finding individual ideas I don't have a problem with. And I would say DXCM now, over the last 4 months, making a pattern of higher highs and higher lows, still the 200-day above current levels. But generally speaking, in terms of the price structure and the momentum, certainly seems to be in a position of strength. Today, we're making a new 3-month high, and I think that just is the latest up move in a chart that's starting to work off of a very low summer 2024 low. All right, let's take a question or two here and see what we can get to. Thanks, Kano the Great, for watching on YouTube. Which bond tickers should I look at? That's a very open-ended question, so I will give you a very open-ended answer. The short answer is it depends. The long answer is here are 3 things I would suggest. If you want to understand the bond markets, at least to a limited degree, here's what I would do. I would look at TLT or AG, either of those. I really don't mind too much which one. AG is the aggregate bond ETF, so it combines corporate bonds and treasury bonds all in one big kind of master index, and that's the main benchmark most bond managers would use to sort of think about the performance of the bond markets. And it's based off of an index that's been around for quite some time. It used to be called the Lehman AG, and then the Barclays AG, and now it's like the Barclays Bloomberg AG or something. But it's basically the bond market. It's kind of like the S&P for the bond market. I usually look at TLT because that's treasury bonds, sort of longer duration treasury bonds. And I think that's just an important area of the market because so many rates that impact you from borrowing and buying a house and stuff like that are essentially based off of treasury bonds, risk-free bonds. So I think tracking the prices there are good. So this is going to help you understand the price of the bond market, the performance of the bond market. So if you want to look at stocks versus bonds, I would do a ratio of the SPY to the TLT. I think that gives you a pretty good relative performance measure. And stocks have been outperforming bonds for quite some time, many, many years. Second thing I would look at and these are stock chart. This is a stock charts ticker, the 10-year treasury yield. Now, different platforms have very different tickers for this. There's very little sort of standards in the financial market data industry on how to tickerize different rates and indexes. So every platform could add a different thing, but you want to look at the 10-year treasury yield. It's kind of like that first chart plotted upside down because it helps you understand the interest rate environment. And so this is looking at the 10-year point on the U.S. Treasury yield curve and looking at basically the yield to maturity, the yield on those 10-year Treasury bonds. This is a key benchmark rate that a lot of other rates, as I mentioned, are based off of. So understanding that rate from a technical perspective, I think, pretty meaningful. So clearly from the last 2 chart, bond prices have been going down, rates have been going up. Now, from that point on, there's a bunch of other things that you could look at. And I'd encourage you to see what others are doing. On my market misbehavior live chart list, which you can find hopefully in a link in the description of my YouTube video, but also if you go to marketmisbehavior.com/charts, you will see a third chart, excuse me, which is one that I showed earlier. which is this one right here. The other thing you do is look at the high yield bond markets. So HYG or JNK, those are the junk bond ETFs. I think those are great. They really trade more like stocks than bonds, but it gives you that, sort of riskier debt and how those are trading. This is looking at credit spreads, which would be another way of looking at the bond markets, basically looking at how corporate bonds are trading as a spread above those risk-free bonds, above treasury bonds. And so by looking at those charts that I mentioned, bond, the TLT or the AG for bond prices, $ TNX or something to look at the 10-year treasury yield, credit spreads and high yield bonds using HYG and JNK, a pretty good sense of what's happening in that area of the market. And I hope those are helpful. I hope that answers your question. Josh, you mentioned the mental side stress of taking half up will help you in trading. It does me at least. Yeah, I had an interview. Thanks for that comment. I appreciate that, Josh. And I interviewed Price Headley, who I've known for a number of years, but haven't kept in as good a touch as I wanted to. I interviewed him in a money show years ago and was talking with Price about position sizing. And his comment was, if you're having trouble sleeping at night, your position size is too big. And I think that's beautiful, right? If you ask, successful investors, like how much do they risk on each position? It's usually in like the 2% range on average. I've heard people go as high as like 5%, but not much more than that. So if you're risking like a ton of your portfolio on individual ideas, it's not surprising if you're feeling really uncomfortable about things because those you're making a huge bet, right? Smaller, calculated, deliberate, thoughtful bets are the way that you can do very, very well. You're not putting as much at risk on each individual idea. Gives you the opportunity to manage incorrect positions or unprofitable positions a lot more easily, and also helps you double down or at least stick with positions that are working because you're able to sort of think about the overall bets that you're making within your portfolio. Great questions. Thanks so much, guys, for watching and for asking some thoughtful questions. As a reminder, we do this show, Chart This with Dave Keller, every weekday after the close. Tomorrow on Friday, January 17th, we will be doing an all mailbag edition. So if you have questions that have been on top of your mind, make sure you go to our YouTube channel, put in a comment below that, any of these recent episodes. I'll look for those questions and hope to answer one of yours on our next mailbag show. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.